Right. I think we are live. Let's just make sure. Sorry for the people watching. Give us just a moment. Just having a little bit of technical difficulties, just trying to get everything set up. All right. Perfect. Perfect. All right. Hello, everyone, and welcome. I'm Daniel Ladd, a business retirement strategist, and I'm excited that you've joined me today to learn about a powerful wealth building strategy that most financial advisors just don't talk about. Now, before we begin, I'm excited to announce everyone who stays until the end of today's webinar on the Zoom will receive a free copy of my Business Retirement Vault ebook, which only sells for $49. And for those who qualify, I'll be offering a complimentary strategy session to see if this approach might be the right situation for yourself. Now, today we're tackling the consultant's dilemma head on. How to stop choosing between easily accessible cash that barely grows and accounts that are high growth but barely accessible. And I'll be showing you the business retirement vault strategy, which eliminates this forced trade off. Now, before we dive in, I want to make it clear about this presentation. It isn't about a high risk investment or get rich quick schemes. Instead, it's about a systematic approach to building wealth that gives you control, protection, and tax advantages that most traditional financial strategies just simply don't offer. Now, let me tell you a little bit about myself. Now, my journey into financial strategies began studying physics at Florida Institute of Technology, and that analytical training taught me to break down complex problems and find solutions others miss. And I approached financial strategies like solving an equation, finding the hidden variables most people overlook. And as a strategist, I've spent years developing expertise in areas that go beyond conventional thinking. Now, in 2024 alone, I helped dozens of clients implement the business retirement vault strategy with remarkable results. Now, what sets my approach apart is my focus on working directly with select clients rather than building a massive following. And I deliberately keep my client base small because this strategy requires customization and personal attention. I'm not selling courses to thousands. I'm working with professionals who meet specific criteria and can truly benefit. This isn't for everyone, and that's by design. My goal is not to help everyone with their financial problems. It's to provide exceptional results for the right clients who are a perfect fit for our strategies. Now, my aha moment came when I realized most professionals face an impossible choice: either save for retirement or keep money liquid for gaps in opportunities. Now, traditional financial planning wasn't designed to solve this challenge. Now, today I'll show you what most professionals do with their money, why those approaches fall short, and a strategy that delivers both long term growth and immediate access when you need it. Now, throughout today's presentation, you'll see how our approach delivers what I call the three L's of financial freedom. That's liquidity, leverage, and legacy. Three elements that most financial strategies force you to choose between. Now, let's establish our example. Now, someone investing $25,000 per year for 10 years, totaling to about $250,000, right? This could be any professional serious about building wealth. And let's see how this performs in different vehicles. So, let me share a real example that illustrates this problem perfectly. One of our clients, Karen, had been in consulting for over 30 years. And after decades of hard work, she finally landed some high paying contracts and started seeing significant income. And like many consultants, she was cautious with her money. She wanted to make sure she had enough liquidity to cover gaps between contracts, meet payroll for her team, and handle any unexpected expenses. So she did what seemed safest. She kept her money in checking and savings accounts. And by the time Karen came to me, she had accumulated hundreds of thousands just sitting in bank accounts. And she thought she was being financially responsible, but in reality, her money was doing virtually nothing for her, with average returns just 0.45% just sitting in savings. Think about that. If you have 1 million sitting in savings accounts, you're earning just $4,500 a year in interest. Meanwhile, inflation's eroding your purchasing power at 3 to 4% annually. Karen was effectively losing money every year despite her impressive savings. And this is the dilemma so many people face. You work incredibly hard to earn the money during your active contracts, but then the fear of liquidity needs during contract gaps forces you to choose between and sacrifice for your long-term financial growth. And the average return in savings accounts is just 0.45%. That's less than 1%. And if you contribute 250,000 over 10 years, that's about $2,083 per month. And your interest earned is only 5,625. Just $562 per year in growth. That's wild. Like, I understand why professionals make this choice. Like, you need the liquidity when contracts end or when opportunities arise, but this approach sacrifices your long-term financial future for short-term access. And Karen's situation is all too common. She was a successful consultant by any measure, but her fear of illiquidity was costing her hundreds of thousands in potential growth. And what she needed wasn't an all or nothing approach, but a strategy that could provide both growth and access. Now, on the other end of the spectrum, many professionals are told to put their money into traditional retirement accounts like 401ks, IRAs, or TSP accounts. Now, on the surface, this seems like a solid approach. Now, my client Brian, he's 50 years young, had accumulated about 800,000 in his TSP account after a successful military career. On paper, he done everything right, according to traditional advice, of course. But here's the problem. He's not able to touch that TSP account until he's 59 and a half without facing significant penalties. And despite saving diligently for decades, he wants to retire early and enjoy the fruits of his labor. But he's forced to either just live off just his pension and limited personal savings until he's 59 and a half, or take on another job during what should be his retirement years, or just pay a hefty penalty to access his own money. This is the fundamental flaw with traditional retirement accounts for consultants and professionals who value flexibility. Now, let's look at the numbers. With an average return around 7% in like the typical 401k space, your $250,000 contributions over 10 years would grow to about 360,593. That's a gain of over 110,000, which sounds impressive, right? But there's a major problem with this picture. It's all before taxes, and you can't access it until retirement without significant penalties. And my client Brian's story is just one example of the inflexibility built into those accounts. For professionals, this is especially problematic when a contract ends unexpectedly or an opportunity requires capital. Your money is locked away, and accessing it before 59 and a half means a 10% penalty plus ordinary income tax, easily 30 to 40% of your hard earned money. Would you be happy with your money being tied up like that? So, while traditional retirement accounts seem attractive on the surface, they create a serious liquidity trap. They force you to choose between savings for retirement or having access to your money when you need it. A choice really no professional should have to make. But here's where the rubber meets the road. Now, following the traditional approach with the 360,593 in your 401k or IRA, using the standard 4% withdrawal rule, you get about $14,424 yearly before tax. And after even a modest tax rate, that's roughly $12,925 a year. That's about $1,077 monthly. Think about that for a moment. After 10 years of diligently contributing $2,083 per month, your monthly retirement income is only $1,077. It's about half of what you're putting in each month. Now, have you ever done this math before? Because most have not. And you also face limited control over your money when you need it most. 10% penalties for early withdrawals during contract gaps or when you just need it for life situations. And you have required minimum distributions when you reach retirement age. Now, and you also get continued exposure to market volatility. And those limitations are especially problematic for those with unpredictable income. Now, there's another issue with market based accounts, the devastating impact of market losses. Like, consider this simple example. You start with $10 in the market, and the market has a bad year and drops 50%. How much do you have left? You only have $5 left, right? Now, the next year, things recovered, and the market went up 50%. How much are you at now? Most think $10, but no, you're actually only at $7.50. That's a mathematical reality that catches many people by surprise. When you lose money in the market, you need a much bigger gain to recover. So if you lose 20% of your money, you need a 25% gain just to break even. But if you lose 50% of your money, you need a 100% gain. The market has to double just for you to get back to zero. And our client Mary, she had about 150,000 in her investment accounts and worked with a full-time advisor who managed her portfolio. And Mary rarely communicated with her advisor because she always felt like she was with the right person. And the real problem was that Mary only looked at the quarterly or monthly statements showing gains, never examining her overall performance. And when we analyzed her portfolio over the past 5 years, we discovered something shocking. She was actually negative 5% overall. Mary had no idea that her retirement money she was living off of had actually decreased by 5% over 5 years, despite what appeared to be gains in some of her statements. She was focused on the trees while missing the forest. And we all saw this play out in 2008. The market crashed 38.5%, then gained 23.5% in 2009. But investors were still significantly underwater. And many people needed years to recover those losses. Like, when was the last time you looked at your overall performance? And for most of us, this recovery time is especially problematic. If the market crashes during a gap between contracts when you might need to access the funds, you're forced into a terrible choice. Either sell at a loss or struggle financially while waiting for a recovery. Now, let's look at a different approach that addresses these unique problems. So here's where things get interesting. What if there was a financial vehicle that was specifically designed to address the consultant's dilemma? And what if you could participate when the market goes up, but completely avoid the losses when it goes down, while still maintaining access to your money during times of need? That's exactly what index accounts offer. Now, an index account is linked to the market, but not directly invested in it. This creates a contractual agreement with two crucial features. First is you'll never lose money due to market performance. That's a contractual guarantee. Second, when the market goes up, your money increases with it. The company just takes a little off top for themselves. Now, unlike traditional investments where you're riding the market roller coaster with no safety rails, index accounts give you protection on the downside while still letting you capture gains. Now, this stability is crucial for those who can't afford to see their accumulated wealth disappear during a market downturn that just happens to coincide with the gap between contracts or retirement. And let me show you how this works with a real example many of us remember. In 2000, the dot-com bubble, the market went down. It dropped 10.1%. Then 2001, down again. And 2002, down again. 3 straight down years. But with an index account, your money stayed right where it was at, 0% each year. No losses. Then in 2003, when the market finally rebounded, it went up 26.4%. This specific index account gained 11.2%. So when the market drops, your money stays put. When it rises, you capture a portion of these gains. And this is why I tell my clients zero is your hero. Because never losing money is incredibly powerful for professionals who need both growth and access and stability. Now, consider the 2008 financial crisis, something most of us remember all too well. The market crashed 38.5%, and some lost entire fortunes that year. Do you know someone that happened to? Unfortunately, most of us do. But index accounts, they stayed right at 0%, not a penny lost. Then in 2009, when the market began recovering with a 23.5% gain, which keep in mind, not enough to get traditional investors back to even, index accounts captured returns between 8.8% and 17.5%. Now, imagine being a professional during that time. While others watch their retirement accounts plummet, those with index accounts maintain their financial foundation. And this provides freedom to be selective about opportunities, negotiate better terms, or even take time off if needed. And looking at a 20-year historical averages across different index accounts tells a compelling story. Some indexes average 7 to 7.3%, others performed even better at 8.1% to 10%. One delivered at 12% average return for the past 20 years. And obviously, these are historical information, and history doesn't dictate what the future is going to do, but it's a good idea of what to look at. Now, combining, sorry, 1 second. Oh, there we go. We're back. All right, so combining these five indexes, the average return was 8.88% average with zero downside risk. And your principal is contractually protected. This is a key advantage that most financial advisors never discuss. You might capture slightly less upside in the very best years, but you never have to recover from losses. You're always moving forward, never backwards. Think about this, how this transforms your financial planning. No more roller coasters. No more watching the news worried about your portfolio. No more hoping you don't face a financial challenge during a market crash. No more feeling like you need to be a financial guru. Instead, you get a steady, predictable growth pattern that creates real financial confidence. And when your life direction isn't guaranteed. And this is where the business retirement vault strategy delivers all three L's of true financial wealth building. First is liquidity. Access your money when you need it without penalties. Two is leverage. Make your money work in multiple places at once through our self banking strategy. Three is legacy. Create wealth that passes to future generations tax free and bypasses probate. Now, while traditional approaches force you to sacrifice at least one of these critical elements, the BRV strategy integrates all three simultaneously. So, let's talk about the business retirement vault strategy. And this is where everything we've discussed comes together to create an ideal solution for professionals. The BRV isn't just a financial product, it's a comprehensive wealth building system. At its core, it's a specifically designed, max funded index universal life policy, but the complete strategy encompasses asset integration, tax optimization, and legacy planning tailored specifically to your situation. But this strategic approach unlocks powerful advantages from IRS Tax Code 101A, creating three game changing benefits. First, your money grows completely tax free, no taxes on the gains. And for consultants and professionals who are already paying significant self employment tax, this tax advantage is substantial. Second, you can access your money without triggering tax events. This is crucial during those inevitable gaps between contracts or when you just need capital for your life or business. And third, the death benefit passes to your heirs tax free, creating a lasting legacy. But the BRV strategy goes well beyond tax advantages. You get zero loss guaranteed protection, growth potential from index linked returns, complete liquidity once funded, and total control over your money, and efficient wealth transfer through strategic structuring. Now, what makes BRV completely different from typical financial approaches is our holistic methodology. We analyze your entire financial picture and we integrate all components from asset positioning to trust structures to cash flow management. And this comprehensive approach allows you to build accessible wealth and create tax free income streams in years, not decades. And this creates a financial foundation that remains stable regardless of income variability or providing both long term growth and immediate accessibility. And we can even integrate your existing retirement accounts and other assets into the strategy, ensuring your money is always working optimally while maintaining the liquidity professionals require. Now, let me show you a real world example that really brings this to life. Here's a case study for a 50-year-old who contributes $25,000 a year for 10 years. That's a total of $250,000. The policy is designed to credit at 6.55%, which is actually conservative compared to the 8.88% historical average we just saw. Now, let's look at what happens. After 10 years, they built over $265,000 in cash value, a solid foundation that remains completely accessible. Now, at age 62, they can take $29,052 in tax free income every single year. And that's providing stable income regardless of workloads. And over their lifetime, that adds up to 1.7 million in tax free income in this example. And while that income, they're taking that, the cash value doesn't deplete. It actually grows to 508 grand by age 70. So let's break this down year by year. So by year 10, they got 265,000 cash value, though they're not taking income yet. But by year 20, their cash value has grown to 508 grand while they were taking that 29,000 annually. And by year 40, their cash value has grown to $2.2 million while still taking the same $29,000 every single year, tax free, I might add. This creates something that traditional financial vehicles can't predict, like predictable tax-free income that isn't dependent on having active work plus access to capital during your working years. Now, think about what this means. 250,000 contributed over 10 years generates nearly $30,000 of annual tax-free income for decades, while the cash value continues to grow instead of depleting. That's the power of becoming your own bank when done properly. Now, I want to share what I consider the most powerful feature of the BRV strategy, the concept of becoming your own bank. And this is what really sets the approach apart and addresses the unique challenges of consulting income. Let me show you exactly how this works. Using our example, the 265,000 in your BRV. After the first 10 years, it's a 3-step process that changes everything about how your money works for you. So you access your money when you need it, right? You take it out and you do what's called an index loan for 265K. The loan interest rate's about 3.2%. That's roughly $8,500 per year. Now, here's the game changer. Your money still grows inside the policy as if you never took it out. That original 265,000 continues growing at around 6.5%, generating about $17,000 annually in tax-free income. And you're asking, what's the bottom line? You're earning $17,000 while paying $8,500 in interest. You're netting $8,500 annually, all while you're using your 265,000 elsewhere. This is the true magic of becoming your own bank. You get to use your money for whatever you need, covering expenses during contract gaps, investing in your business, or handling personal financial needs, while the same money continues growing inside the policy. Think about this real life example. A 50-year-old consultant builds up 265,000 after 10 years. They can take about 29,000 per year in tax-free income. Their account value grows to over 500,000 by age 70, and over their lifetime, that can amount to over 1.7 million in tax-free income, and whatever's left goes to your family tax-free. So this solves the impossible choice between growth and access. You're not just earning a return. You're creating a financial system that works for you through both active contract periods and those inevitable gaps. Now, let's compare the business retirement vault strategy to traditional 401k IRA approach. So this is where the difference really becomes clear for professionals. Both approaches start with the same 250,000 over 10 years. But what happens next is dramatically different. So after 10 years, the traditional approach shows about 360,000, which looks better at first glance. Now the BRV shows about 265,000, which seems smaller initially. But when we look at the income, the traditional approach gives you around $13,000 per year after taxes, while the BRV gives you around $29,000 completely tax-free per year. That's more than double the income. And here's what happens over time. With traditional approaches, your account value decreases every year as you take withdrawals. With the BRV, your account value actually increases to over 500,000 by even while you're taking income. And for consultants specifically, the traditional approach, you're exposed to the market. And if the market crashes, which could be potentially during your contract gap, while the BRV approach, you have zero loss protection, regardless of market conditions. When it comes to accessing your money, traditional approaches, you got limited access, penalties, required distributions, and it's all taxed. Now, the BRV approach, you have control. It's your money. Use it when contracts end or opportunities arise. But this is why professionals like yourself are diversifying into these strategies. Now, let me share a real quick example that shows. Oh, sorry. Give me 1 second. Lost the live on TikTok. Give us just a moment. And we're back. So let me go over this real quick example that shows the power of the strategy specifically for consultants, but can be used for just about anybody. Now, my client Karen is a consultant who was completely focused on growing her business with almost no retirement planning. And she had some money in an IRA, but no real strategy for handling the inconsistent income that came with her consulting work. And when we showed her how much of her retirement savings would be lost to taxes and how inaccessible her money would be during contract gaps, she was stunned. This was something her previous financial advisor had never explained to her. And we helped her implement the business retirement vault, and just 3 years later, it proved its value in a way that traditional accounts never could. Like when her son needed $7,000 to pay off his car during a period when she was at the end of one of her major contracts, she was able to borrow the money from her policy tax free in less than a week. And the loan was just at 3.2%. And remarkably, that 7,000 she borrowed continued growing inside her policy as if she never touched it. This gave her the incredible peace of mind knowing she could help her family without disrupting her long-term financial strategy. She's now repaying that loan on her own terms with no fixed schedule while building significant tax free wealth for her future. And most importantly, she's no longer stressed about contract gaps because she knows she has a financial foundation that works regardless of her consulting schedule. This is the business retirement vault in action, providing both immediate liquidity when life happens and long term financial security without compromise. Now, to summarize what we covered today, the Biz Retirement Vault delivers on all three L's of wealth and gives you a unique combination of benefits. You get protection from market losses during contract gaps, competitive growth potential, historical averages between 6 and 8%, tax free growth and access, the ability to become your own bank, long term tax free income, and liquidity when you need it most. And unlike traditional retirement accounts, this strategy gives you complete control over your money, regardless of contract status, protection from market volatility, and access to your capital when needed. And you get substantial tax advantages and the ability to start building generational wealth. Now, skip this. Well, now that you understand how the business retirement vault works for professionals like yourself, let me share why scheduling a strategy session today is critical, if this approach interests you, of course. The reality is, most people miss is the qualification for this strategy is not guaranteed. I had a client recently who was excited about implementing this approach. He scheduled our strategy session, but decided to postpone finalizing things. But because of some routine medical appointment, during those appointments, they discovered a serious health condition. They actually found out he had cancer. And despite his financial qualifications and genuine interest, he became instantly uninsurable for the strategy. And he can't do it anymore. This isn't uncommon. These companies backing these policies are highly selective. It's precisely why they can offer guaranteed protection we've discussed, because their strict underwriting standards are why you'll never lose money due to market performance. Now, beyond health considerations, there's also a hidden cost of waiting. For every $100,000 you have sitting idle in low interest accounts, you're potentially leaving $6,000 to $15,000 on the table annually. And that compounds year after year. And that money, it can't be recovered. So if you're interested in seeing how this could work for your specific situation, your next step is scheduling a complimentary strategy session. During this personalized consultation, we'll analyze your current financial setup, identify optimization opportunities, determine if you meet the qualification criteria for the strategy, and we'll create a custom structure that maximizes your specific situation. And I'll show you exactly how the numbers would work for your goals. And I'll give you a clear and honest assessment, even if it means telling you this isn't the right fit for you. Now, what this makes is different from like your typical financial consultation is that I'm not looking to simply sell products, as I mentioned earlier. I deliberately maintain a small client base because proper implementation requires ongoing guidance and customization. And each structure needs to be precisely calibrated to avoid just becoming another underperforming asset like most people have. Now, due to the depth of analysis and customization involved, I only have a few consultation slots available over the next 2 weeks. These are allocated on a first come, first served basis. Now, to reserve your complimentary strategy session, You can click the link that'll appear in the chat a little bit later, or you can text BRV to 321 282 6801. Again, that's BRV to 321 282 6801. You also can click on the link or type in businessretirementvault.com/book now, and you'll be able to select a convenient time for us to connect. You can see that on the screen right there. Now, remember, even if you ultimately decide this strategy isn't for you, you'll walk away with clarity about your options and specific recommendations for your situation. This consultation itself delivers value regardless of what you decide. And thank you for joining me today. I hope this presentation is giving you valuable insight into a different approach to wealth building. Now, I'd like to open the floor for questions. This is your opportunity to get clarity on anything we discussed today or ask about how the Business Retirement Vault might apply to your specific situation. And so I want to start by answering some of the common questions I get the most often from clients. And while I'm going through these, please feel free to type any other questions you have in the chat. I'll keep an eye out on the chats and address as many of your individual questions as I can in the next few minutes. Keep in mind, we have this on almost every platform, so it might give me a minute on that side. And if we run out of time, you can schedule a call and we can go from there. But let's start with the first common question I get, which is, how is this different from a Roth IRA? So unlike Roth IRAs, there's no 59 and a half age restriction or 5-year waiting period to access your money. You have complete flexibility with no contribution limits, while you can still enjoy the tax-free growth and distributions. Now, this gives you access during contract gaps without penalties. Now, another question I often hear is, what are the health requirements and how does this work? So first and foremost is a holistic approach, right? The life insurance side that we were talking about earlier is one component. There's multiple components that we do to this. But when it comes to the health requirements, it does vary by company, but here's what's important. Our strategies focuses on cash value growth, not maximum insurance. And we developed approaches that work for most health situations. Even if you're not in perfect health, we can typically find a solution that delivers similar returns while meeting your goals. Another question I get is, how quickly can I access my money? We can structure your plan for accessibility in the first year if needed, or design it for longer term growth. But like any financial vehicle, allowing time for growth is ideal. But we customize the accessibility timeline based on your specific cash flow needs. But keep in mind, either you have time or you have money. But if we're constantly taking the money away and not giving enough time to do anything, of course it's not going to grow very big, right? This isn't a get rich quick scheme, right? There's nothing out there without extreme risk that you can do that with. Now, another question I get is, what happens if I can't make payments during a period of time? So this is exactly why we create flexible plans. These aren't life insurance plans. Let me clarify that. We're not paying premiums forever until you pass away. That's a life insurance plan. That's not a strategic business retirement vault or be your own bank strategy. Our goal is to build the bank, have it funded fully, and once it's fully funded, you don't put a single penny in. And we strategically structure them to accommodate variable income patterns for consulting or business owners. And your plan can be designed with built-in flexibility to handle those inevitable contract gaps without derailing your whole long-term strategy. Next common question I get is, a lot of business models have their own intricacies. So people ask is like, how customizable is this for my situation or my business? Complete customization is the cornerstone of our approach. Every plan is built specifically for your unique situation, contract cycles, and goals. This level of customization is why I limit the number of clients that we work with each year. These aren't off-the-shelf solutions. You can go find any other person in the financial sector to give you an off-the-shelf solution. Don't worry about coming to me for that. So the next question goes towards like, how do you leverage money, right? Or how does the leveraging returns work? So and it comes specifically, what are the tax implications of policy loans? So policy loans remain completely tax-free as long as the policy stays in force. And we carefully structure your plan to avoid creating what's called a modified endowment contract, or a MEC is commonly known, which could change the tax treatment. And this ensures your access to funds so it maintains its tax-free status. Next is, people ask is like, how does the index side of things work? So, or how does the zero loss protection work? Your money is tied to an index account with a contractual floor of 0. So what that means is that the company measures the performance on a year-to-year basis. So January 1st to January 1st of 2020, whatever, right? Or whatever month you put in your premiums. Now, if the market goes up, you participate in those gains. If the market goes down, your principal remains intact. And this creates steady, consistent growth over time without the setback of market losses. Lastly, people ask, what happens if tax laws change? 1 second. So I have to reconnect TikTok. Okay, connected. So people ask, what happens if tax laws change? So life insurance taxation has remained fundamentally unchanged since World War II. Because these policies are legally defined as life insurance and not investments, they operate under a different section of the tax code. Okay, we're still live. Cool. Um, the death benefit structure ensures that they maintain their tax advantages despite changing political environments. Now that I've addressed those common questions, I want to transition to the chat and address as many of your individual questions as I can. Let me take a quick look and see what's coming in. And if you have not put in your questions into the chat, please do so now. All right, all right, we have John. All right, John on Facebook. So John's asking, what, how long does it take to get everything started? So here's the thing. First, we have to make sure the strategy makes sense for you. That's number one. This does not work for everyone. This is not something designed for everyone, right? Can anybody get these products? Yes, but if you're actually trying to have an optimized product where your product is being productive for in terms of the strategy that I am talking about, then it needs to be structured for a specific situation. That's number one. Now, we can get typically it takes anywhere from 2 weeks to 2 months to get this done full bore, start to finish, anything we have to get done, right? Um, Other question on that side, yes, there is medical, which I did explain earlier. Now, and there you do have to be financially qualified for this. It's not everybody can get qualified for this on the financial side or the medical side, just to clarify. All right, next question. So, all right, Ryan's asking about what if I transition my 401k into this? How would that work? That's a great question. So, as a tax strategist, right, we have to look at your entire portfolio, see what you're doing with it. And oftentimes we can maneuver that into this strategy, but we have to be strategic because we're trying to, one, make sure we're minimizing your taxes because once you put your money into that 401k, you have already agreed to the contract with the government that's stating, hey, I'm going to tax defer my money. So that means I'm going to push off the money until I want to pull out money, and at that point, I'm agreeing that I will pay taxes on whatever the current tax bracket is. That's what happens when you put money into a 401k, an IRA, any of that, right? So we have strategies, but it's not a one size fits all strategy. Just to clarify. So a lot of just so you guys know in general, a lot of these things they don't work simply. You have to be strategic in what you do. You have to be specific in what you do for them to work. All right. Let me see. What other questions we got? And if you have any other questions, please input them in now. Let's see. And then on the YouTube. Okay. So the question's coming from Brianna. So Brianna wants to know how is this tax free? Like, how does that work? Is this legal? That kind of stuff. All right. So I'm going to explain this to you as simply as I can. So, life insurance, number one, anything defined as a life insurance death benefit under the tax code 101A and Tefra Defra and Tamra is tax free. That's part of the IRS tax code. That is number one. Key crucial point here is that you need a life insurance component for this to be tax-free for this strategy without having to worry about, retirement rules. That's very crucial to understand. So when you take a life insurance policy that is specifically structured and you add in a specific amount of cash that's still within the tax code limits, where we're max funding it, but we're not funding it where it goes past the tax laws TEFRA and DEFRA and TAMRA, but we're funding it to the brim under legal tax code. That's where we get our money to grow tax-free without market loss, because we are attaching a specifically picked out and structured life insurance policy with a cash account. And by them being together, the way the IRS looks at it is they look at it as one entity. They don't look at it as two entities. They don't look at it as your cash and your life insurance. They look at it all as life insurance. And life insurance is not classified as an investment, right? It's classified as a legally binding contract that goes to your family guaranteed based on whatever the death benefit was agreed upon and the premiums you agreed to pay them. As long as those two things match, the contract is valid. So I hope that explains that. But with that, guys, that is all the time I've got. If I didn't get to your question today, or if you think of additional questions later, please be sure to schedule a complimentary strategy session with me. The link you can see right there is on the screen, which is businessretirementvault.com/book now. businessretirementvault.com/book now. You can also text me BRV at 321-282-6801. Again, that's 321-282-6801. Thank you again for today. And I hope you have a blessed day. And don't forget that every day that you're sitting here waiting and looking for opportunities, you're wasting money. You need to be optimize your money. Whether you do anything with me or you do something with someone else, it does not matter. With that, you guys have a great rest of your day. I'm ending the live now. Bye for now.